Even if you have a very small account, there's a simple option strategy that takes minutes to learn and can be traded every day. In this video, you'll learn the exact steps to do all of this. I'm Mike Bellafiore, and we're one of the top proprietary trading firms located in New York City since 2005 and proud to have developed numerous 7 and even 8-figure per year traders. Watch, take notes, and learn from the head of our options trading desk so you can grow your trading account.
Hi, I'm Seth Freiberg, and I'm the head trader of SMB Capital's options trading desk here in Manhattan. And while we have traders that have access to millions of dollars of capital here at the firm, we're also in contact with traders all over the world, maybe like yourself, that are just getting started trading, and they have some limitations on their capital and can fund an account with, say, $1,000 initially, but that's all that they can do initially. And so I often get asked, if I only have $1,000 in my account, does that mean I can't really trade the option strategies that you guys trade? And the good news is that many option strategies can be traded with a small account. And that's what this video is about, to teach you a strategy that can easily be traded with a $1,000 capital account using index options. And all you need to do is learn the 3 easy steps to putting this trade on. Now, before we get into the option strategy that we're going to be teaching you in the video, if you're absolutely brand new to options trading and you don't know much about how options work, we put together a video for you to understand options basics. And if you click the video appearing on your screen right now, it will lay the groundwork for you to understand the option strategy that we'll be teaching you in this video. Then, when you're finished, you can come back and watch the rest of this video. To illustrate this strategy, which is a trade you can actually take every single trading day of the week, let's head back to the first trading day of this month, June 3rd. And as you can see, the SPX index, which represents the basket of stocks comprising the S&P 500 index, had opened at 5295.73 that morning. And so the first step in the process of making this trade is to pull up an options chain expiring that same day, what are known as 0 DTE options, and find both the call and put option which are closest to where the market opened that morning, which was the 52.95 strike price that morning. And right after the opening bell, we go ahead and sell the 52.95 call and the 52.95 put simultaneously in a transaction known in the options world as a short at the money straddle. And in a minute, we'll explain to you why you are doing this, but let's move on to the second step, which is to, on the same options chain, buy what options traders refer to as a long strangle, 20 points out of the money by buying a call 20 points above the short call up at 53.15 and simultaneously buying a long put 20 points below the short put at 52.75. And when he's completed that, then he has constructed what options traders refer to as an iron butterfly. And in fact, any competent options broker platform is going to have a drop-down menu that will allow you to execute all 4 parts of this trade at once if you select the iron butterfly option on the drop-down menu. So now let's break down what's happened here from a cash flow standpoint so you can understand how the trade works. And so starting with the call we sold at the money at 52.95, we received the price of $9.65 for those. But remember, index options pay off at $100 per point beyond the option strike price when they settle. So you multiply that by 100, and thus we received $965 for the short call. And using the same approach, we see that we've received $920 for the 52.95 put we sold. And then the protective call up at 53.15 cost us $215, while the protective put down at 52.75 cost us $320. So netting it all down, we received $1,350 in cash in our account when we entered this trade. And so you might be asking, hey, the market just handed me $1,350 in cash when I entered the trade, but how much capital will I need for the trade? Because I've only got $1,000 in my account. And so the way that you can figure that out is that you take the distance between the short and long options and you multiply that by 100, and then you subtract out the premium received. And so, as we mentioned earlier, the distance between the short and long options was 20 points because the long call was 20 points above the short call and the long put was 20 points below the short put. And so in both cases, the distance is 20 points because the long options are equidistant from the short options. And as we just calculated, the premium was $13.50. And so if we apply the formula, you can see that 20 times 100 is 2,000 minus the $13.50 premium received for a net capital requirement of $650 on this trade, well within the $1,000 account limitation that we've given ourselves for the purposes of this video. And so now let's move to a little later that morning at 10:10 a.m. And as you can see, the price of SPX dropped from its opening $52.95 price down slightly to $52.90 at 10:10 a.m. And so you'd expect that the calls would lose value and the puts would gain value if the market sold off, which is exactly what happened. And so now it's time to take the third and final step in trading the strategy, and that is either to take the trade off at a profit if the level of the trade profit is 10% of the capital required on the trade, or take a loss if the profit level is 20% of the capital required. And so how can we determine if we'd hit 10% profit or 20% loss? And so the easiest way to know that is to ask yourself, if I close the trade right now, buying back the options I sold and selling the options I bought, what would be the outcome of the trade? So let's see how that would play out if at 10:10 that day we had closed the trade just that way. And so starting with the initial premium we received, that $1,350, we'll then note, as you can see, that we needed to pay $6.55 to buy back the short call, resulting in a payment of $655 and $11.60 to close the short put. But then we sold off the longs for positive cash flow, resulting in, if we were to close the trade now, a profit of $73, which, as you can see, is above our trade threshold of 10% of the required trade capital. And that's it. We're done for the day, and our $1,000 account is now up $73 to $1,073. And the reason this happens is that as options move closer and closer to the time that they expire, which is 4 p.m. each day on 0 DTE options, they start shedding some of the premium that they originally had when we first entered the trade in a process known to options traders as time decay. And since the options we sold had much more premium than the ones we bought, they had more premium to lose than the ones we bought that were 20 points out of the money. And so if the market doesn't move around a whole lot from the time we put the trade on, by 30 to 90 minutes into the trading session, they will have already lost a good deal of their premium because the market is only open 6.5 hours each day. So 30 to 90 minutes is actually a long time when it comes to a market day. And so oftentimes the premiums on those short options, which had much more premium to lose in the first place, will have lost so much compared to how much the long options lost, that if you bought the shorts back and sold the longs off like we did in this case, you'll very often find that you don't need to pay as much to buy it back as you had received when you sold it, which of course is because of that time decay we mentioned a minute ago. And that's why the trade works basically. The relative time decay of the short options versus the relative time decay of the long options. And so let's now move to the next day and just rinse and repeat. And so on this day, the market had opened at 52.65.12, and so the at the money strike was obviously the 52.65 call and put, which we sell, and we buy the 52.85 call and also buy the 52.45 put to complete, again, our iron butterfly. And the positive cash flow in this case is, as you can see, $14.95. And therefore, as we explained before, the capital requirement would be $505. And so now moving to 10:55 on that same day, 85 minutes into the market, so much longer than the previous case, by the way, it turns out that the market was trading at 52.67, which is only 2 points from where it opened at 52.65. And so in this case, all of the options have shrunk in value because of that natural time decay of options premium. But in this case, since the market hardly moved at all 4 of the options lost value. And so if we tried to close the trade at this point, we'd find that, again, starting with the $14.95 we collected in the beginning of the trade, we'd have to spend $11.70 and $9.80 to buy back the call and put, but we can sell off the long options for $3.55 and $3.80, resulting in a profit of $80, which in this case represented more than a 15% return on the capital in the Tuesday trade. And so as not to be too tedious, we could just show you that both the June 5th and June 6th trades were also profitable. But then we came to the June 7th trade, the Friday trade, with the market opening at 53.31 and the trade being centered at 53.30, therefore. And as you can see, we collected this time $1,515, which results in a capital requirement of $485. But this time, the market moved quite a bit. And so let's take a look at what happened by 10 a.m. that day. And as you can see, the market rallied more than 17 points, resulting in the calls really exploding in value. And the puts really dropped substantially as well. And when we get such a strong move like that, so quickly earlier in the day, the result often is going to be that the effect on the short option on the side of the move, in other words, the short calls in the case of a rally or the short puts in the case of a sell-off, those short options are going to blow up so much because they're located right where the index is trading at the open. So the deeper the market penetrates that side, the more the trader is at risk of that option closing really deep in the money, causing it to have to pay off a huge amount of cash. And so that price has to just keep rising very aggressively to keep up with that move. And when that happens, particularly early in the day, like 10 a.m., then there isn't enough time for that time decay to meaningfully drop the options prices like they did in the earlier cases. And so what often happens is a loss. And so let's see what takes place on this trade. And so if you wanted to buy back the trade at 10 a.m., here's the calculation, with the one really getting clobbered being that 53.30 call, which blew up and priced at 23.55, way more than we were paid to sell it in the first place. And so the loss on that option is so bad that it throws us into a loss on the whole trade. And by 10 a.m., that loss had climbed to $110, which is our stop, resulting in a loss of more than 20%. So we've got to close that trade. And so now we can complete that week's scorecard. And as you can see, the trade won 4 out of 5 times that week, resulting in a $201 profit for the week, a 20% return in a week on a $1,000 account. And you'll notice the capital requirement of any one trade never got even close to $1,000. And so what I'd like you to take away from today's video is that you can easily trade options income strategies with a small account, and many traders like to use systematic strategies like this iron butterfly trade with a modest target profit and maximum loss, and simply repeat it each day. Many of the one-day strategies can end within the first 60 to 90 minutes of the day and would be perfect for folks who want to start learning about how to trade options, but may not be able to sit in front of the screen all day and may not have all that much capital. Now, I'd like to caution you that you need to establish on a trade like this exactly what is the optimal target profit and maximum loss on any repeated strategy, and you would be best served doing that by backtesting multiple different combinations of target profit and maximum loss percentages until you settle on one that seems to have long-term edge. The 10% profit target, 20% max loss example in this video is a possibility, but you'll need to work on that yourselves to see if that has long-term edge or perhaps some other combination may make more sense. That's the experimentation piece that's so necessary and that all hard-working professional options traders will undertake before they get serious about any repetitive option strategy like the one we presented in today's video. So don't be shy about learning to trade if you have a small account. There's a boatload of strategies that small account traders can use to build their confidence as traders over time.
Now, if you'd like to learn 3 more option strategies that our pro traders use, including the unique options trick that allows you to make money while you wait to buy stocks or ETFs at the price you want, and the options income strategy that allows you to make consistent money whether the market goes up or down or sideways, and how to make money on a stock or index trade even if you're wrong on the direction, then click the link that's appearing right now at the top right-hand corner of your screen. That will open up the free workshop registration page in a new window. So don't worry, you won't lose this video. Or you can register directly for free at optionsclass.com.